Why did Netflix intentionally force its stock price down to $100 exactly 18 days before buying Warner Brothers? On the surface, it looks like a standard 10-for-1 stock split, which I'll explain in this video. But when you look at the dates, it looks like a calculated maneuver. Most investors see two separate headlines. I see a strategic setup. I believe the decision for this stock split was a strategic signal that the Warner Brothers deal was sealed, signed, and delivered weeks ago. But there's actually a bigger secret no one is talking about. A secret that involves a specific VIP list of companies that Netflix has been effectively banned from joining for 20 years. I believe this 10-for-1 split was the final key to unlocking that door. It's a move that evolves the company from a tech trade to a forever hold. I'll explain exactly what that is and why it matters for your portfolio at the end of this video. But first, let's look at the dates. On October 21st, Warner Brothers officially announces they're open for a sale. Like day one of a homeowner planting the for sale sign in their front yard. Just 9 days later, that's October 30th, Netflix announces a 10-for-1 stock split that will take place, coincidentally, 18 days later on November 17th. Now, corporate finance doesn't happen overnight. You don't wake up on a Tuesday and decide, hey, you know what? We're going to do a stock split 10-to-1. This was planned. The fact that the split announcement happened 9 days after Warner put themselves on the market tells me talks were likely already happening. But here's the kicker. On December 5th, the acquisition is announced. That's only 18 days after the split was executed. Why does this matter? Well, because of the magnitude of the split. Historically, over the last 20 years of the stock market, 95% of stock splits have been small, usually 2-for-1 or 3-for-1. Netflix was trading at around $1,000 pre-split, and they opted for a 10-for-1 split. What does that mean? Well, as a Netflix shareholder, for every one share that you own, you get 9 additional shares at a tenth of the price. For example, let's say you owned 100 shares at $1,000 per share pre-split. After the split, you now own 1,000 shares at $100 per share. If Netflix management was nervous about the Warner deal, if they thought, hey, regulators might kill this, or Wall Street might hate the debt for this acquisition, they would have played it safe. They could have done a 2-for-1 split. That puts the share price at $500. If the stock drops 20%, you're at $400. That's still a premium price tag. It looks strong. But they didn't do that. They went aggressive. A 10-for-1 split. That forced the share price down to $100. And at the time of this video, it's dropped to $93 in change. That was a confident move. Why? Because there is no buffer at $100. If the market hated the Warner Brothers deal and the stock dropped 20%, Netflix would be trading at $80 a share. And to be fair, we could be headed that direction. $80 a share looks like a penny stock compared to their tech peers. For example, Meta is currently $650 per share. Tesla and Microsoft, both around $475 per share. Management chose a price point, $100, that requires momentum to look good. They burned the boats. They expect growth. And history backs them up. When we look at super splits, these massive 10-for-1 or 7-for-1 events, the returns crush the market. Look at MasterCard. They did a 10-for-1 split back in 2014. Look at the chart since then. The stock appreciated over 200% in the following 5 years. Apple split their stock 7-for-1 in 2014. 5 years later, the stock had doubled in value. The average 5-year return on these massive splits is typically between 190% to 225%. Compare that to the S&P 500 average of 60 to 70% over a 5-year period. We can even see this in Netflix's own history. In 2004, they did a small 2-for-1 split. The result? The stock was stagnant for 5 years, due in part to the 2008 recession. In 2015, they did a massive 7-for-1 split. The result? 388% gains over the next 5 years. Yes, 388% in gains. Big splits signal big cycles. Small splits signal maintenance. This was a big split. Finally, there's one more reason why the 10-for-1 split was genius regarding the Warner Brothers deal. Optics. Netflix is buying a major iconic studio that owns Harry Potter, The Lord of the Rings, Game of Thrones, and Batman. The FTC and regulators are going to be watching this like hawks. Psychologically, a company trading at $1,000 per share looks like a behemoth. It looks like a monopoly. But a company trading at $95 or $100, it feels democratic. It feels smaller. By slashing the price to $100 right before announcing a mega merger, they made the pill easier for the public and regulators to swallow. So, the split makes the stock accessible, and the Warner Brothers deal provides the growth. But remember that VIP list I mentioned at the start? Here's the secret. I believe this 10-for-1 split is Netflix preparing to be added to the Dow Jones Industrial Average. Here's why. Unlike the S&P 500, the Dow Jones is highly exclusive. It only has 30 stocks, including iconic brands like Coca-Cola, Nike, and Disney. It's also a price-weighted index. That means a stock trading at $1,000 literally cannot be in the index. It would break the math. They only accept stocks in the $50 to $150 range. By splitting to $100, Netflix has removed the only technical barrier standing in their way. And think about it. They just bought Warner Brothers. They're no longer just a tech streamer. They're now a legacy Hollywood institution, a true blue chip media giant. My theory is Netflix will replace a company like Disney or Intel in the Dow Jones within the next 12 to 24 months. The Warner deal makes them worthy. The stock split makes them eligible. Why is this good for us shareholders? It's not about the stock price popping overnight. It's about graduation. Getting into the Dow brings in the forever money, pension funds and sovereign wealth funds that buy and hold for decades, not days. It transforms Netflix from a volatile tech stock into a stable blue chip empire. It dampens the downside during crashes and validates that Netflix is here to stay for the next 50 years. So, what do you think? Let me know in the comments. Do you think Netflix is headed for the Dow? And are you buying at these levels? Don't forget to like and subscribe if you enjoyed this video, and I'll see you in the next one.